welcome to Law Talk, the show that brings the Constitution, the news, and politics into one location. That's your living room. Mark, what are we covering tonight?
Well, first of all, Jim, now Law Talk is on Facebook. So we want everyone to go to facebook.com/Law Talk TV show and take a look and make a comment or befriend us or whatever.
Yeah, I noticed that we actually have access to the shows through that website. Isn't that correct?
Well, yeah, if you go through YouTube, we have through Facebook, go to YouTube, we have a few shows on YouTube.
Okay, so that way if you missed any of the shows, you can go back and kind of look them up.
Well,
right?
we have some more that we need to load on there, but we've got a few up on there.
Well, okay, Mark, so what are we covering tonight?
Well, there's a estate and tax cliff coming up on January 1st, 2013.
What kind of cliff is that, Mark?
Well, what happened is there was a political showdown in Congress and between the president and what they decided we're going to push everything off to after the election, right?
Oh, you're talking. Isn't this what happened in 2010? When it was the sundown of the Bush tax cuts? Isn't that when it came up?
Well, I don't really think that there's such a thing as a tax cut myself.
Okay.
I think people honestly earn money, and then where constitutionally applicable, the government can tax that, but there's really no such thing as a tax cut. I mean, people earn the money, they own that money, and in certain conditions under the enumerated clauses, the government has a right to tax them, but there's really no such thing as a tax cut. I mean, it starts out as the earner's money.
If I remember correctly, this country was started to abolish taxes, and there's nothing really in the Constitution that allows taxation. The taxation started as an administrative action, and so when we talk about a constitutional right to tax people out of their hard-earned money, it doesn't really exist. So,
well, in the enumerated clauses, it talks about tariffs and import tariffs and excise taxes. So there is taxation.
Does it talk about the income tax?
No, it does not.
Does it talk about the state tax?
No, it does not.
Does it talk about real property tax?
No, it does not.
So those are taxes that are being applied to us that don't really have a rational basis in the Constitution.
But under the living Constitution.
The living
Constitution, you have the necessary proper cause.
Okay.
Which is a catch-all of anything that you can come up with as long as you have the votes to do it.
So what we've been told all these years on taxation is it's necessary and proper to tax the people for their hard-earned money so that we ensure that the government can operate to provide for those people that don't want to work with and earn hard-earned money.
No, the necessary proper cause just basically says whoever's in power
can do
whatever they want. Okay, but really, so basically what it comes down, January 1st, 2013, estate taxes have an exemption of $5 million per person.
That's currently.
Yeah, lifetime exemption. But January 1st, coming up in a couple of months, that's going to go, well, actually, right now it's $5,120,000 because there were some adjustments for inflation.
But that means that if anything, that number and below is not a taxable.
It's exempt.
On the estate tax. When it means you inherit it, you don't have to pay a tax on it.
That's correct.
Okay.
Now, that's going to drop down to $1 million on January 1st.
That's a dramatic drop.
Yeah, and the thing is, people go, well, if someone's got $5 million, I mean, if you're an Occupy Wall Street person, well, those people, we should just kill them and take all their money. And that would be fair. But if you killed everybody, all the rich people, like your 1%, and you took all their money, it would only run the government for a period of weeks.
Were we talking about this as 6 days? It would run the government.
That
means that would be all the money taken from all the people that are classified in the 1%.
So I mean, you can't really, So what I'm saying, that's one viewpoint is that no one should inherit anything, right?
Yeah, but that means if you die,
right,
and your family you've raised them from small children, and you want to pass your wealth on to them.
That's unfair.
That's not fair.
That's unfair.
But who's not fair? Who's it not fair for?
Well, the thing about it, it's not fair for the people who don't have rich parents. So that's unfair. And so that's one of the good things about this. As far as Occupy Wall Street, you shouldn't be able to pass anything. It should be 100% death tax. And that, at this point, it's going from $5 million to $1 million. People go, $5 million, that's a lot of money. But let's say you have a family business. $5 million.
Or you own a ranch or a farm.
A ranch or apartment building or something like that. That's what you put your life's work in, and you want to pass that on to your kids. You can be in that area of money.
Well, you can be right there. It's not even cash in the bank. It could just be a piece of real property.
You have a nice house in San Francisco.
And that would be it. But see, that makes it that makes it very unfortunate because oftentimes people can't pay those taxes. If say the sundown actually happens and it drops from $5 million to $1 million, and you have a property that's worth $3 million, and you have to pay taxes on the $3 million, because not only is it a sundown on the $5 million to $1 million,
well, wait, it gets better. It gets better.
So we're talking about raising the percentage as well.
And it's not only okay. Not only does it go from $5,120,000 to $1 million, but it also goes from 35% up to 55%. So
that's a lot of money,
taxes
Mark.
Going up. So there's a lot of things you have to do. Yeah, you can inherit a property, and then how are you going to pay the tax on it?
You have to sell the property.
Well, and there's other things you could do if you did proper estate planning. We'll talk about that a little bit more. But yeah, you could take out life insurance on the person who holds the property now, and then that life insurance policy could maybe cover those taxes. You could form a family limited partnership. There's certain things you could do with different trusts, certain things you could do with LLCs, limited liability companies. So there's lots of things you could do.
You want to give me an example on how a limited family partnership would help us?
Okay, a family limited partnership could be set up like this. It's rather complex in some ways, but it's an interesting vehicle, investment and estate vehicle. You could set up the limited partnership. Those could be the parents, for example, right? And then the general partners could be all the children. So let's say, just for example, you had, 5 kids and 15 grandchildren or something like that, right? So, and then you had a $5 million property that made a 10% profit every year. So you're making $500,000 a year in profit. You could right now get your husband and wife together, and they could each have a $13,000 per year gift exemption, right?
Right.
Combine that, husband and wife, you have $26,000. Now this is apart from your $5 million. And every year, if you have 20 kids, you could give
away with a gift amount without a taxation issue.
Yeah, $520,000 a year. You could do that for over many years.
Right.
And that way, the kids would be limited partners, so they couldn't go and squander the money until such time as you could put in the agreement. They maybe after they're 35 or 45, they can attack the trust or whatever.
Right.
And that would be a way of transferring wealth to the next generation.
Right. So you could have a spendthrift clause in there, so the kids don't have the opportunity to really spend the money as fast as it may be earned. But also, you're avoiding the taxation issue by under the gift exemption.
Right.
So you're giving each of the beneficiaries gifts that are below the gift exemption. So that means there's no taxation issue on that. And so what happens next is the parents in this case are giving away their ownership interest at some level. But ultimately there's still going to be a number at the end of time when both parents are gone, and it's going to have to actually pass to the next level of beneficiary. Okay, so what happens at that point?
Okay, well there's a fair amount of debate on that, between trusts and wills and AB trusts and certain exempted things. But what you're going to end up, one of the nuances of a family limited partnership is that, let's say you have a $1 million piece of property, right?
Right.
Now, but if you have a shared ownership, the value of that property decreases because you don't have control, right? Let's say you have a piece of property, right? Mm-hmm. But let's say you have a piece of property, you own it with your 2 brothers.
Correct.
Okay.
Correct.
Well,
in some kind of limited partnership.
Now you don't have control. If you want to sell it, your brother may not want to sell it, or the other one might want to sell it for a different price.
Right.
So the fact that you lose some amount of control on that and some kind of liquidity, that devalues that property somewhat.
Or like a depreciation.
There's a certain amount of depreciation.
Depreciation allowance.
So in a certain way, that also comes into play in your family limited partnership because you're splitting it amongst your siblings, so there is you get some tax credit there.
Correct.
So there you go. So those are some of the ways you can do it.
But wait a minute, what's going to be the alternative? The alternative is going to be that when January 1st, 2013 comes around, they extend the so-called Bush tax cuts, and they actually allow this current estate program to go forward. What do you think the odds are on that?
Well, like I said, I don't believe in the terminology of a tax cut. I don't believe there's such a thing.
Right.
I mean, people earn money. The government taxes where it's constitutionally able to do so, but you can't really have a tax cut. I mean, But anyway, you can say there's an absence of a tax, but or the absence of a raise. But what we would say, if this is going to change, it depends on which party wins. If you have the Republican Party win, they may remain the same. If the Democrats win, it'll probably reduce. Whether it'll go down to 1 million or maybe it'll be 2 or 3 million, it'll probably be reduced.
Okay, well, why don't we cover this, because you know what, January 1st is going to be coming up, and we're going to find out what happened in the election during our next show. So why don't we leave that and let's move